Good afternoon, everyone, and welcome to this week's Insignio Speaker Series. I'm happy to be joined today by Jason Borbora. Jason, thank you for joining us today.
Thank you. Pleasure.
So Jason is a portfolio manager within the multi-asset team at 91. Jason, tell us a little bit about your role at 91 and what you do over there.
Sure. So I co-manage our income strategy with John Stopford. I basically look after the portfolio from a construction perspective, along with John. And really, it's about coordinating with the rest of the team in selecting the individual securities that go into the strategy, looking then at how they combine in terms of their correlations with one another, and then management of hedging in order to try and mitigate capital loss.
Right. So tell us a little bit about the strategies that you manage. They obviously have the word income in there. They also have multi-asset. So people can sort of get a rough sense of what's in there, but give us some more details, please.
Sure. So I think actually the name is somewhat misleading. And ultimately what the fund is trying to do, if you think about the world from a risk and return perspective, and so on the sort of far left, and now at quite a high level of income, you've got cash, you've got short duration bonds, buying a 2-year maturity bond, for example. Then you go a bit further to the right. So you take on a bit more risk and you've got, say, short duration credit or short duration high yield. And as you travel further, you then come across income funds. And we sit there. So we are very much not like a balanced strategy. We are not like a multi-asset strategy or even other funds that are called global multi-asset income. We are much more like, if I throw some bigger names out there, so a PIMCO income, a Lord Abbett multi-sector income, that's where we're sitting between a sort of short duration credit and those sorts of strategies. So what you should expect from us is a yield-driven return. And currently we're sitting on about 6% with good downside characteristics. So last year, for example, we were only down 5%, and other strategies which have a similar outcome were down between 10 and 20. So we're trying to be defensive for our clients.
And how were you able to, for example, manage such outperformance last year? Were you taking a really short duration bet? Were you taking bets? Are you able to take shorts?
Yeah.
Tell us a little bit about how you managed to do that.
Sure. So it starts really from stage one of the process where the bond selection was particularly strong. So this is a fixed income replacement strategy, if you want to think about it in those terms. And what we own is quite different, though, to what you'll get if you're just buying a treasury or you're buying a bond fund. So most of our bond exposure was through New Zealand, Canada, Australia, on the view that they would see less significant and less sustained rate rises because they've got very leveraged housing markets, unlike the US, which has actually got very few mortgages relative to its past and very long duration mortgages. So our bond selection was very strong. We then managed the duration down, as you suggest. We were below 1 year. And then also what we were doing into the fourth quarter of last year was adding call options on equity markets. And what that actually helped to do was then, as the market rallied in the fourth quarter, give us some upside participation. So it was a mixture of good bond selection and then the hedging strategy.
So far, you've only mentioned fixed income. Are you only involved in fixed income? Or are you also involved in, let's say, preferreds and other asset classes that pay income as well?
Yes. So 90% of the fund is fixed income. There's then 10% in, effectively, we see them as bonds, but investors may call them equities. And that's because ultimately, if you look at, say, a Johnson & Johnson or a Procter & Gamble, yes, they're very small in terms of our exposure, 10% now, but they really act like a TIP, like a Treasury inflation protected bond, because you look at those dividend per shares and they've risen every single year for over 60 years. That to us is like getting a real coupon. And so, yes, we have some of that non-fixed income, but it is effectively a bond. The strategy is effectively a bond. You could think of it as a 3-year bond at the underlying. It's 2/3 sovereign with then a call option strategy on top of that to give you the participation if actually the cautious view which we hold doesn't manifest itself and actually things are much more rosy in a year's time.
So are you essentially just targeting a certain income stream, a certain yield? How do you position your portfolio? How are you managing volatility?
Yeah, so typically we're looking for around 4% yield, and that relates to what you normally get from safe assets, which is CPI +2. We've now seen CPI go from sort of sub 2 in the last 3 or 4 years up to high single digits, and even in some developed markets to double digits. So we are seeing quite a lot of volatility in yields. We ultimately are looking where do you get the safest source of income, which is we now think in fixed income. And that's why it's so predominantly orientated towards that. And specifically within sovereigns, we're very concerned about corporates, actually, where we think that the risk of defaults, the risk of downgrades aren't properly reflected in what you're getting paid in spreads. So we put the fund together based on where are you getting the most resilient, the safest, reliable yield, and manage risks based on correlation. So, for example, bond correlation to equity has a relationship itself with inflation. And when that's volatile or high, you're going to see bonds behave more like stocks. And therefore, in order to be defensive, as we were last year, you have to actually manage your duration down as a risk. But that's actually something that you've had to do. The fund is now, strategy is now 11 years old and $4 billion in size. So we've had to do this before, but last year was a very significant example of that.
Right. So let's step away a little bit from the idiosyncrasies of the fund and the strategy itself, and let's talk about your macro view. Because obviously that has to have a major impact in how you position the portfolio and it must guide you along the process. So give us your 30,000-foot macro view right now, the state of, let's not talk just about the US economy. Let's talk about the European Union as well. Let's talk about China. There's a lot of concerns about how fast China is going to actually be growing in this post-pandemic era. So maybe give us some of your thoughts there. And then maybe we can also talk to, and then get into sort of as a second part, some of the more attractive bond markets you see out there, because there's certainly concerns with the U.S. bond market. I'm talking about the Treasury market specifically, right? So maybe we can talk about that as well.
Okay, so if we were on the macro side, work backwards, we do China, Europe, US. China, I think, is facing a fork in the road where either it is going to throw the kitchen sink at it and stimulate in the way that it has basically since 2001, or they are missing the step here, and we're going to see a very significant crash in the property market. I do think it's either going to be gangbusters or it's going to be horrendous. And more of the data recently has unfortunately suggested the latter route is a possibility. So we are quite concerned that there's been a loss of confidence in the consumer who used property as effectively an investment. And that's why you get these stats like there were 2.3 homes per person and there are so many vacant houses around the place. So we're quite concerned that the loss of confidence in property that stemmed from regulation initially, but now seems to have morphed into something more concerning, could present significant downside to China. But what they've done historically, as soon as they've reached this junction, actually normally a little bit earlier, is just spend money on infrastructure and spend money on property. And I guess that's what's likely to happen, more likely than not, but it does create concern. Onto the European Union, it looks dreadful.
Do you, just a quick question, do you see a systemic financial risk there, risk of contagion in some of the larger commercial banks in China?
Yeah, if that property crisis plays out, then definitely. But I think it's high impact, low probability. The most likely thing is they muddle through, as they've done most of the time. They sort of drip feed stimulus through, and then before you know it, they've actually started growth back up in your mid-single to high single digits. For the moment, though, it doesn't really, to me, pay to be overly exposed to that dynamic, and it's downside risk ultimately. So Europe suffers from what happens to China. So that you've got to remember going forward is potentially going to be pulling down on growth. It has its own issues as a union, I think, structurally, because you have countries with very different positions from an export perspective. And what works for Germany doesn't necessarily work for Italy, but you've got only one currency to deal with the whole problem. I think that is a difficulty for any economy. And ultimately, what we're seeing in Europe so far is some pretty dreadful data. So, PMI is out yesterday, for example, and I'd include the UK in that too. Looks very, very concerning. And actually, you've seen natural gas prices move up once more over the last few weeks. So we're quite pessimistic on Europe. I think that's very easily our least favored area. And then finally, the US. I mean, the US is looking, to all intents and purposes, incredibly strong. I think you've got to disaggregate the here and now from the future. So the here and now suggests less rate sensitivity than many had expected, higher rates of growth, potentially a higher natural interest rate that it can sustain. The future, though, looks to me like we're going to see a slowdown into the fourth quarter / first quarter of next year. And really, you can distill that down to excess savings dynamics, whereby during COVID, there was massive fiscal and monetary stimulus. Excess savings went beyond anything we'd seen in the last 40 to 50 years. And as a consequence of that, people actually have been, in a strange way, benefiting from higher rates. They've been getting more income on the back of them. but those excess savings appear to be fading fast, particularly amongst lower income cohorts, the least well off. And actually, I think that dynamic by the end of this year is going to mean that rate sensitivity represents itself. You've already seen, housing initially took a dive, then it seems to have wanted to rebound, but as soon as yields more recently have gone up again, the higher frequency data is suggesting it's slowing again. So our view is ultimately that the US is going to be in a slowdown, a meaningful slowdown. I'm not saying it's going to be a dreadful recession by the end of this year, start of next. I think it's the length of the recession, not the depth, that's going to matter this time. And that relates to inflation.
Okay. So where would you, given this sort of overall view right now, where would you suggest investors who are looking for income, who are looking for non-volatile income producing assets to be looking for opportunities?
So I think you need to go beyond just the short duration and cash holdings. Yes, they should make up a decent chunk of your positions, but there are 4 reasons why we are positioning the fund longer duration. The first is reinvestment risk, because if you're just sat there clipping the coupon on something going to maturity, you ultimately aren't locking in very attractive rates that are available to you in a longer time. And that's why
are you finding attractive rates right now further out in the curves?
For sure. So longer dated Canada, Australia, New Zealand, I think look pretty compelling. Europe too, given the dynamic of very poor data there, which is unlikely to sustain higher rates. And to an extent also in the US, not quite as much yet, but certainly so. What we then do is actually manage the overall duration down. So the fund's duration is going to range between 1 and 4 years, but we're buying longer dated bonds and then hedging the overall duration back so that it behaves like a short maturity bond, but its capital gain drivers are quite different. So I think that's one area to think about. I think
what are you using to hedge that duration risk? Are you using interest rates? What kind of instruments are you using?
Interest rate swaps and bond futures.
No? Okay.
Exactly. We use the most liquid instruments on the most liquid markets, basically. So that's one area. The other is then the risk of, just cash and only holding, your 1 or 2 year bonds is opportunity cost, which could be severe. And I think options are a very interesting way of mitigating that, because the last thing you want to do when you're getting a decent yield on cash is suddenly find yourself losing money on markets. That's completely understandable. But given where volatility is, that's the key input to options pricing. We can buy call options between 4 and 6 months in maturity, struck at between 5 and 10% away from the current price of the S&P for participation in the upside. And I think that combination of you've got at your core a kind of longer maturity bond, but you're managing the vol down, so it's behaving like a short maturity bond and giving you a decent income, almost 6% now, and then you're adding the call options to cover you if our pessimistic view doesn't play out. I think that's a nice balance between covering you for the base case, where you actually make good money out of quality instruments, and the upside case, where actually equity is going to run hard if ultimately there's no recession.
Right. And your base case right now, you sort of mentioned it, but what are some of the risks out there, both to the upside and downside, that you're monitoring it? Because that's going to affect also your portfolio, your portfolio construction. So maybe get into that for a little bit, please.
Exactly. Okay. So base case is roughly 65% in our view that we get a slowdown in growth, that it's going to come in the fourth quarter, that it's going to be then very manifest in the first or second quarter of next year. And what's interesting is, to the here and now versus the future, you go back to 1990, you go back to 2007, you go back to just before COVID, and growth can look fabulous in the quarter preceding a very big downturn. So it being strong now is no indicator that it won't be weaker in the future. So that's the base case. There's the upside case then, which we've got about 15% probability on, and that's where inflation basically slows dramatically, but growth doesn't meaningfully. And there are actually quite a few examples. You go back to after World War II, 1946 to 48, inflation at one point hit 20%, and then we were actually in outright deflation with a very mild recession. And that potentially is where your upside for risk assets is, because that's a sort of soft landing scenario. I think it's just less probable given how much tightening has been done and how quickly. There's very few episodes where a soft landing has been realized where rates have gone this far, this fast. So that's why it's lower probability. Then there's a 20% risk case for us on actually growth doesn't slow at all and inflation actually picks up again. And you can make a case for that where, data isn't moving down meaningfully. Yes, that doesn't stop it from doing so in the future, but it so far hasn't. And there are reasons to, you could make a reason for thinking inflation could pick back up again. The base effects in core inflation, particularly in goods, mean that this year, unless we get that slowdown in growth, you could make a case for inflation pickup. And that's where you rerun last year. And it's pretty damning for certainly risk assets, most bonds also. The only good thing is you're now getting 5 and a bit on cash. And so you can combine some more safe instruments in the fund, I think.
So tell us how you would adjust the portfolio given those two risks. How would you lean it? What tactical changes would you make if you were to see, let's say, increased odds of any of those risks come to fruition?
Okay, so base case, if that starts to play out, we're going to take the longer duration bonds that we're owning and make them shorter duration because you'll benefit from rate cuts. Middle case, where you get no real slowdown in growth, but actually inflation's coming off a lot, the call options are already covering us for that. So that's kind of going to be taken care of by that. And you need to do that now in advance because you can't wait for it to happen and then try and participate. Right. The weak scenario the weak performance scenario, we're going to need to be cutting back duration in the fund as we did last year. We're going to need to be ultimately willing to forego that call premium because that's not going to be rallying in that context. And I think that is where it's important that the fund's defensive position from its yield is much higher. It's starting at 6%, whereas it started 2022 at 4%. And that gives you that buffer against going negative. But ultimately, it's not going to be you're not going to be making money in that environment. It's about trying to minimize capital loss like we did last year. So it's going to be managing the duration risk down in the fund.
Excellent. So I'd like to remind everyone that if you do have any questions, please submit them via the chat. I'd be happy to share them with him with Jason as soon as we finish our conversation here, which will be over shortly. Jason, let me ask you a couple of things. Some of the names you've mentioned in passing have been in the developed world. Yes. You've mentioned Australia, you've mentioned Canada. Obviously, we've talked about the United States, we've talked about Europe. Is there space or scope in your fund and in your strategy to look beyond the developed world? We've seen, I would venture to say, pretty strong outperformance from many emerging markets this year. Particularly given the monetary policy stance of the United States. I think most people, if you would have told them at the beginning of the year that the re-rating would have happened to the upside on the Fed expectations rather to the downside, I think most people would tell you that EM would have a difficult time. I think if you told most people you would have China's recovery faltering here, they would probably tell you EM would probably not do so well. But we've seen several markets. I think the resiliency has been quite outstanding. Are you investing, looking at these markets, or is this something that is just not a part of your fund, given the nature of your sort of low vol income strategy?
It's how you own it that's important, as you say, in this sort of strategy. So we really like EM local currency bonds, buying them, then hedging them back to dollars. And that is very different from buying hard currency, because buying EM hard currency is a bit like buying a high yield corporate. And neither of those two assets do we like, mainly because of their sensitivity to downside in recessions. So what we have had actually quite meaningful exposure to are things like Brazil, 3 or 4 year maturity bond, hedged back to dollars, where you're still getting a decent carry. And we ultimately see where inflation's coming down to low single digits, the potential for rate cuts ahead of what the market is priced for. So you'll get both capital gain and income from those positions. And so we've actually had quite meaningful, around 15% of the fund exposure to that asset class, but it is about hedging out the FX risk. And you basically take your vol from, if you buy a standard EM, local currency bond ETF, your vol's probably around 12, nearly like a sort of equity vol. You hedge it back and your vol's more like 4, and it behaves like a sort of low risk treasury. So it is about being very precise about the maturity and also the currency exposure and not running that FX risk.
Okay, excellent. Jason, so I do have a few questions here that I want to get to that have been handed from the field. The first question is, are there any Latin American countries that you're looking at or that you potentially have exposure in?
Yeah, so Brazil was one that I mentioned there as an example. The other is Mexico. That's a bit more of a beta to the US treasury market. But again, similar dynamic in terms of taking out the FX risk. A little bit longer on the curve, actually, in Mexico relative to someone like Brazil. But yes, so I think those areas where ultimately the EM led DM in raising rates, and because of that, they have got credibility on managing inflation down, and are successful in doing that. So those areas we like, but again, we're not going to have lots, and it's going to be currency hedged given the risk of the fund.
This one might be slightly out of your wheelhouse, but I'll chance it anyway. Do you have a comment in versus the European versus the U.S. banking sector?
Yeah, it's not really our forte.
Yeah,
I mean, I would say Europe as an economy is much weaker than the US. So
sure.
that for me
Yeah,
would be
I think they're alluding to because European bank shares have actually done pretty well compared to the U.S. banking sector recently. I think they're trying to get to whether that makes sense to continue or not. But let me ask you here also, in terms of Europe, are there any countries or sovereigns that you prefer over some others?
Yeah, quality is key at the moment. So if you look at our fund, the average credit quality is A plus, and that's because of our exposure where we have, for example, European bond duration is mostly to Germany. So we would avoid, for example, Italy if you're buying, if you're buying bonds today. Ultimately, the big area of concern for me is corporate bonds, and that, if you look across markets, has a dynamic that stems from investment grade risk actually. So you look at the investment grade market, and half of that is now triple B. Our concern is that ultimately in a downgrade cycle, which is driven by an earnings recession, some of that goes into high yield. And so initially it will spread widen because ultimately investment grade managers mostly are ETFs and they'll sell out of those positions because it's not in the benchmark. That will fall into high yield. And then the double Bs and Bs in high yield now will get sold to take account of those fallen angels. And I think the risk of high yield and investment grade is very high. You look at their performance in recessions, and you've seen in the GFC 30% losses on high yield. You actually saw nearly 30% losses on short duration high yield. So that was no hiding place. And investment grade was down around 20. So I'm very concerned about corporates overall. It's got to be about the quality of the bond you're buying at the moment.
Mm-hmm. I've noticed in your fact sheet here that roughly 99%, slightly more, is basically US dollar exposure. You mentioned that you hedge out the currency risk when you invest in local debt, especially in EM. You sort of have some marginal exposure to the yen, to the Kiwi, krona, Aussie. Let me ask you this as a sort of broader macro comment. Are you concerned with the fiscal trajectory of the United States and the strength of the US dollar over time? That's question number one. And number two, if you are you able to take, is there a sort of limit to how much non-US dollar exposure you can take in the strategy?
This fund's always going to be hedged back to dollars, just because you think about what a bond is, you can't really have FX risk in and amongst your exposures. So it's always going to be a rounding error FX if you would think about it in that way. Mm-hmm. We are concerned, yes. I think the big issue is distinguishing between cyclical and structural forces. Cyclically, I think that ultimately we're going to see a slowdown in growth, and that's going to emanate from the US, but it's going to drag other economies with it. And as a consequence of that, I think bonds do pretty well. And I think the dollar potentially has its, smile theory, whereby it actually performs pretty strongly too, because typically as the, however you want to phrase it, least dirty shirt in the wash, whatever, it actually benefits in a slowdown environment. I think though then, as we move into the next cycle, there is a big risk that inflation is going to settle at a high level. And fiscally, I think that relates to how debt is going to be managed in the US, which looks on a structural basis pretty concerning. And that leads me to be pretty cautious structurally on bonds, actually, and also concerned about dollar volatility. I think we need to see how that shapes up. But most of the indications we have at this point are that inflation is going to have more drivers to the upside than it did post GFC. And that might prove to have been a pretty unusual aberration. But again, this is once we've seen what the nature of any slowdown coming looks like.
What possible candidates or let's say what opportunity sets out there are you looking at to potentially replace, for example, some of the let's say the anti-fragile characteristics of treasuries, right?
Yeah, options massively. So I think options are going to be key in a structural sense to managing downside.
Okay, excellent. Thank you so much, Jason. We'll really appreciate your time. I think you're joining us from Europe. It seems like it's nighttime over there, given the lighting there. So appreciate it. I know it's pretty late, so thank you for taking the time, and we hope to have you join again. Maybe close us out here with a sort of few sort of key metrics of the fund. Sort of length of time it's been around. It's 3-5 year return history, volatility history.
Yeah, sure. So the fund's been around now or the strategy's been around for 11 years. This fund has just had its 10th year. It's delivered you 4% annualized return for a little less than 4% vol. And if you look at that relative to income funds, that is a high level of return for less vol and less drawdown than all of the big names. If you look at it against bonds, we've delivered roughly 70% of the upside of the global ag for only 15% of the downside. I think that skew is key, because if what we've been discussing comes true cyclically and structurally, cyclically, you're going to make some good money over the next 12 months, because ultimately you're starting with a 6% yield and potentially you've got 3 years of duration benefiting from rate cuts. So you can make your way from that to high single digit returns over 12 months, which is compelling against cash, I think, and against short duration bonds. But then structurally, that skew and that use, particularly of things like options, is going to be important, because if returns are lumpy, then ultimately you need something that can take some of the upside but navigate the downside. And clearly, we were down only 5% last year when assets were down between 10 and 20, and that shows you that we can fight on the downside too.
Excellent, so much. Well, I encourage everyone to take a look at the 91 multi-asset income strategy. Jason, again, thank you for joining us. Have a good evening.
Pleasure. Thank you very much. Take care. Nice to meet you.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.